Everything in this video is not intended as financial or investment advice and is for educational purposes only. I'm Josh Olszewicz, the head of research at Valkyrie. Let's take a look at the midweek market update. I'm recording this before the FOMC meeting this week. The Fed is very likely to raise rates 75 basis points or more tomorrow. Market pricing in 100 basis point hike at around 16%. What happens tomorrow is less important than any color or commentary on the forward guidance in regards to terminal rate, upcoming hikes, etc., etc. Powell is likely to say nothing new. Inflation is still high. We will still beat inflation. We will do that by raising rates. End of story. I'm sure he will get asked about the terminal rate, if he thinks there is a terminal rate, when he thinks easing is going to happen, etc. But tomorrow is going to be nothing new, most likely. In the macro vein, I also like to pay attention to the VIX. Bitcoin is an inverse VIX, global 24/7. So if VIX is rising, we're typically not too bullish on BTC generally. And I also like to look at DXY, which continues to push multi-year highs. So collectively, rates, VIX, DXY, the macro headwinds are very strong for BTC and other digital assets to do well in this environment. The good news here is that the DXY from a technical perspective continues to make higher highs on less and less momentum as measured by the RSI. And this is what's known as a bearish divergence. Not only that, it has a bit of a rising wedge characteristic to it. So as a technical trade setup, I like this for a reversal eventually. The problem with divergences is they can last for a significant period of time, specifically in the TradFi legacy space. Other examples of that are the euro, which had a 2-year bullish divergence, arguably, consecutive lower lows in price, higher lows in RSI, and now it's got a pretty hefty bullish divergence working for it. On the technical side of things, on the fundamental, what's happening on the ground side of things in Europe, obviously that's a different story relative to where the end is for what's going on with energy and Russia and inflation over there. And I like watching divergences because if I'm long or short or looking to go long or short, it's one thing that can nudge me in one direction or the other. Should I close here? Should I add here? Should I open here? So would I be opening a short with this type of picture? I would not, regardless of what's happening on the ground in Europe. And the same with DXY. I would not in good conscience open a long up here with a chart that looks like this on a third higher high on less momentum. Because even if this goes higher, if this goes against me, I'm thinking I'm an idiot, right? What was I thinking? This is obviously not how this works. You can't just make momentum out of nowhere when it comes to trading. Oil is another good example of year-long bullish divergence here. We've got all sorts of divergences recently on all these highs. Bull div, bear div, hidden bull div, all sorts of stuff. Nothing immediately here, but these do play out more often than not as expected. Another reason I like to watch them, they have a high hit rate. Now, if we look at BTC back to 2021, again, a series of higher highs on less and less momentum. The all-time high also had a bearish divergence. And the current environment, the current price structure, arguably has a weak bullish divergence. You're getting equal lows with less momentum. ETH has a similar picture. It's got a lower low on equal momentum. So none of these are strongly bullish or bearish for BTC or ETH in the divergence camp. And speaking of ETH, the merge went well. There are no issues that I've identified or seen anyone identify when it comes to validators or transactions or bridges or DeFi or oracles or DEXs or lending and borrowing. It was as painless and seamless as you'd hoped it would go. So really the best case scenario on all fronts when it comes to the transition for ETH. For Bitcoin, the on-chain activity has been flat, slightly rising week over week. In recent weeks, obviously since 2012, we've had massive on-chain activity increases relative to where we've been. But there are still people transacting on the network regardless of price. There's still activity regardless of price. Things are still going on in the BTC front regardless of price. Transactions in the pink there, active addresses in the green. And for ETH, again, similar story. Flat, slightly rising. Hard to know what that really means relative to proof of work, proof of stake. We will know in weeks and months from now if this looks different, how it looks different. There are no scaling initiatives with the merge. That'll come much later. And then you may see significant rises in on-chain activity just based on what's allowable with throughput. But for now, it probably is going to look very much like it did before the merge until those changes are implemented. But good news all around though, transactions are completely fine from that front. Validators continue to rise. Validators represent 32 ETH staked. They have an opportunity to get selected at random by the network to basically confirm and validate the chain and the transactions. I'm oversimplifying that. But as an investor and a trader, what I care about here is, are validators rising or falling? In ETH's case, validators can't get out of the system yet. That's going to happen 6 to 12 months from now when that code is written, tested, and implemented. It hasn't even happened yet. So right now it's a one-way street. You can become a validator. You cannot not become a validator, right? You can't unstake your ETH. So that supply is continually getting sucked out of the system. Validators are also punished for bad behavior, which is one way to keep the chain honest. If I'm a validator and I want to try some funny business and the chain catches me, it takes some of my stake. This is called slashing. And slashing events are rare, historically have been rare. And we didn't see a spike in slashing events post-merge. We haven't seen that yet. So from a security perspective of the network, things look to be fine. From a transactions standpoint, again, there are no massive backlogs. Things seem to be working in order as you'd expect. Pending transactions essentially falling over the past few weeks. So in any measurable way, ETH looks completely fine from a chain perspective. ETHW, on the other hand, I haven't seen any stats really on ETHW. ETHW is the fork that decided to keep proof of work. Probably just a nonsense cash grab, definitely a zombie. It does not have DeFi community developers. It has nothing. It did get listed in a few places, including Kraken. Kraken did distribute it to its customers. I'm sure all the other exchanges will eventually distribute ETHW to their customers, potentially list the token as well, but this will likely remain a zombie for the rest of its natural days, whatever that is. It is unlikely to capture much of an audience anywhere. Now, ETH is proof of stake, and it is in the grouping of other layer ones that are also proof of stake. So we can start to compare these now apples to apples and say, okay, what's the reward here? What's the issuance here relative to Sol, Cardano, BNB, Tron, AVAX, Atom, Matic, Near, Dot, right? All of these can talk to each other. They have interoperability in that they have some sort of EVM compatibility, which just means you can transfer assets between the chains here. So bridges are important. Another thing that's important, again, back to the validators, is how much of the circulating supply is being staked. For ETH, that's around 12%, which is quite low. But again, once your ETH is sent into the network as a validator, it cannot be unlocked. So that probably partially explains why that's so low. It looks like the norm for staking is somewhere between 55 and 65% on average as far as circulating supply, potentially. So if we're thinking about theoretically, where could the staking ratio go? How will that affect rewards? How will the supply soak affect price? These are all things that I like to think about. And additionally, relative to every other chain that's a layer one here, there has to be a pretty good reason to trade something instead of ETH, because people are going to start comparing, as they have been for months now, comparing ETH to all these other chains. What is the dev community? What is the stablecoin connectivity? What is the TVL? What is the issuance, right? These are more in the fundamental side of the analysis in my head, but you'll also be comparing this to price head to head, right? Who's winning here? Is it a rise in Solana relative to a rise in ETH? Is ETH beating the world, right? You're going to see that sort of analysis cropping up more and more now that we can actually compare these apples to apples. They're effectively increasingly similar networks. Now, what's not on this chart is degrees of centralization or decentralization that some of these chains may have. But unfortunately, honestly, that's really usually very unimportant for price until it's of utmost importance. So we're not quite there yet with ETH and most of these, but some things to think about, some things to take away would just be, there are now at least 10 pretty decently positioned networks that are ETH-like, including ETH. So you could say nine sort of ETH killers that have been spun up very recently. We'll see if any of that materializes against ETH. That's something to watch for weeks to months from now. From the on-chain activity perspective, I did notice AVAX again pop up as showing significant on-chain activity. Now, the issue with this is how much of this represents layer 1 versus layer 2. Does layer 2 transactional activity mean value accrual for layer 1, in this case the AVAX token? It doesn't appear as though it has been based on this. That may change, but it's important to realize what you're looking at if you're looking at on-chain activity stats like this, and you're seeing month over month, week over week rises. Why isn't price responding, right? What's going on here? You need to know a little bit about the chain architecture of AVAX, and that most of the value accrual occurs on the C chain, not necessarily the P chain or the X chain. This gets super complex, but the transactions on a chain that matters relatively to price is, as you'd expect it to be, flat and down, which is why price is flat and down. So to me, this says, okay, layer 2 activity might be popping off. There might be a party on layer 2, but price will be quiet on layer 1 because the C chain is not seeing the same sort of activity there. Flipping gears to stablecoins, a few weeks ago, the Tether shorters were very loud. The USDC maxis were very loud. We heard a lot about USDC flipping Tether. As far as circulating supply, I don't have a dog in the fight. I think it's just interesting that people are trying to short a stablecoin. Good for them. I wish them the best. But Tether appears to be sticking around another day, and USDC is slightly falling out of favor. Really, for me, the takeaway from this chart is, despite price being down, 50% plus for a lot of these digital assets, the money in the pipes in the system in the form of stablecoins has not declined in similar fashions, right? We're still seeing significant amounts of stablecoin with USD reserves in the ecosystem, whether it be on DeFi or exchanges or wherever it is, it's still existing. So Tether looks to have stabilized, USDC falling off, BUSD in the blue here rising slightly week over week, and MakerDAO's DAI sort of flat and down. BUSD continues to rise as they are onboarding new chains. They're introducing interoperability between AVAX and Matic. This is sort of a dig at USDC and Tether. Again, they're trying to use their stablecoin with their interoperability, which from a business perspective makes total sense. And it's a win-win for the networks at the end of the day because they see exposure to more stablecoin, more inflows, more ways to transact on those chains. Flipping gears to technicals, we have BTC here, and going into FOMC, knowing that we're probably seeing a 75 or 100 basis point rate hike, knowing that the market's going to react pretty violently probably to that, I'd expect these levels to get tested on the downside, regardless of whether or not the market knows it's coming. We're currently at the 2017 all-time high, just sort of hanging out here. But what I don't like is when we are constantly banging on the door for lows. I don't have a bullish outlook here. We're still in this bearish downtrend, pitchfork below the 200-week, MA below the 200-day EMA. So the next obvious question is, okay, can TA help us figure out where price may go from here? Now, the channel tells you, okay, 15 is reasonable, 14 is reasonable. Should this decline continue the current path? But we can look at a few other things. This is the 200-day and 200-week MAs, which have never crossed. Not much data here, obviously, but something to watch for is, what do we look like a few weeks from now? I'm not going to say months. I'm going to say weeks, when these two MAs could get closer together. I can tell you, sitting through the decline in 2015, that it felt like failed experiment territory. Was I still buying? Of course I was, because I'm here. I'm here till the end. But the sentiment at that time was probably the lowest I've ever seen it, heard it, been a part of the community. We were retesting the early 2015 lows. It wasn't good. Now, we're not quite there yet in sentiment, from my measure. So we'll see how these MAs look in a few weeks. If we want to zoom in on near term, we can look at the high and low of the range, use the Fibonacci extension tool to the downside in this case, and measure where this may go. 12.5, 14.8 based on TA, knowing nothing about the consequences of those levels for price, perfectly reasonable. Doesn't mean I want price to go down there, but if I'm mapping out my decision tree, thinking, okay, where could we go? That's a reasonable level. We can also look at the power law corridor, which is a measure of the previous 3 all-time highs. It's a line of best fit to that. It also gives you a good sense of where we looked in previous bear markets relative to this logarithmic regression. And if we zoom in a little bit to the potential downside here, it's within the limits of sort of what you'd expect historically for price. So not out of the question by any means. ETH, similar picture here at the 200 week, at the 2018 all-time high within this downward channel, got denied earlier this week on a potential exit of this channel, still below the 200-day moving average, right? All the litmus tests for me are telling me, yeah, this thing is still bearish. Expect lower lows over higher highs. Expect continued downside for now, right? This is what a trend is all about. It is telling you, yeah, perfectly reasonable that we continue lows despite the merge being successful, despite all the activity on the chain. Price trend is still definitely there. And if we measure ETH's downside using Fibonacci extensions, we get a retest of that $1,000 level, retest of previous lows from June, July. So it's certainly within the cards here. If markets continue to be bearish on risk assets. That's all I have for this one for this week. If you'd like to hear more from Valkyrie in the content department, we have a daily news brief and a weekly Monday review. You can sign up for those on our website. Like, dislike, comment, share, subscribe, and happy trading.